Software as a service. It is one of the fastest-growing business models in the world, but it is also an absolute minefield for accountants. How do you recognize revenue when a software contract bundles setup fees, professional services, software access, and premium support, all into one single invoice? Hello everyone, and welcome back. I am Suresh Periyasamy, a CPA in both Canada and the US, and an FCA in Sri Lanka. Today we are going to master SaaS revenue recognition. We will take a complex, multi-element tech contract and run it through the rigorous 5-step model under IFRS 15 and ASC 606. Let's get started. Let's meet our company. CloudNova Solutions is a B2B enterprise software provider. On January 1st, 2026, they signed a non-cancelable 3-year contract with Global Corp. Because Global Corp has great credit, they pay the entire contract upfront on day one. Let's look at the invoice. It shows a $50,000 non-refundable setup fee, $70,000 for custom data migration, $360,000 for 3 years of cloud ERP access, and $120,000 for premium support. The total stated value of this contract is exactly $600,000. Assuming step 1 is met and we have a valid contract, we move to the most critical phase for a SaaS company. Step 2. We must identify the performance obligations. To do this, we ask, which of these promises are distinct? Can the customer benefit from them on their own? Let's look at the data migration. Yes, Global Corp could hire a third-party consultant to do this. Therefore, it has standalone value. It is our first distinct obligation. What about that $50,000 setup fee? CloudNova is just provisioning servers and setting up passwords. This does not transfer any real service the customer can use on its own. It is just a fulfillment activity. Therefore, it is not distinct. It must be bundled together with the core SaaS subscription. Finally, the premium support. Because it provides dedicated account managers above and beyond the standard software warranty, it is our third distinct obligation. Now for step 3, determining the transaction price. In SaaS, you must always look out for the SLA, or service level agreement. In this contract, if CloudNova's servers drop below 99.9% uptime, they must refund $20,000 a year. This creates variable consideration. Do we deduct this from our price? We look to the constraint. CloudNova's historical data proves they consistently maintain 99.99% uptime. Because management determines it is highly probable that they will not trigger the penalty is constrained to 0. Our transaction price remains the fixed $600,000. Here is where the math gets interesting. Step 4. CloudNova gave Global Corp a bundled discount. Because of this, under IFRS 15, we must completely ignore the prices printed on the invoice. Instead, we allocate that $600,000 total based on the relative standalone selling price. If CloudNova sold these items separately to other customers, migration is worth $100,000. SaaS Plus setup is worth $450,000, and support is worth $150,000. The true standalone value is $700,000. We calculate the percentage each item represents of the total, and multiply that percentage by our actual $600,000 contract. Notice what happened here. The non-refundable $50,000 setup fee is completely gone. It has been legally absorbed into the SaaS allocation and will be recognized slowly over the 3-year term. Finally, step 5. When do we actually book the revenue? For the data migration, we recognize it over time as the work is performed. Let's assume the engineers finish this in exactly 3 months, by March 31st. For the SaaS platform and the premium support, we also recognize this over time. We will amortize it evenly over the 36-month access period, which begins April 1st, right after the migration is finished. Let's look at the journal entries for the first quarter of year 1. On January 1st, Global Corp wires us $600,000. But we haven't done any work yet. So we debit cash for $600,000, and we strictly credit contract liability, also known as deferred revenue, for $600,000. Fast forward to March 31st. The data migration is complete. We can now recognize that specific performance obligation. We debit our deferred revenue to reduce the liability by $85,800, and we credit professional services revenue for the exact same amount. Now we fast forward to December 31st, the end of year 1. The software and support have been actively used by the client for exactly 9 months, from April through December. We take our allocated SaaS total of $385,800 and divide by 36 months. Multiply that by 9 months, and we get $96,450. We do the exact same math for the support revenue. For our year-end journal entry, we debit deferred revenue for a total of $128,000, $550, and we credit our respective SaaS and support revenue accounts. When we publish our balance sheet on December 31st, what do we tell the investors? We started with $600,000 in deferred revenue and recognized a portion for migration, SaaS, and support. We currently have exactly $385,650 remaining in deferred revenue. But we must split this. The amount we will earn over the next 12 months in 2027 is classified as a current liability. The remainder, representing the final 15 months of the contract, is classified as a non-current liability. Before we wrap up, let's review the top 3 SaaS accounting traps you must avoid. Trap number 1, the setup fee. Never recognize administrative onboarding fees upfront on day 1, even if they are heavily billed and non-refundable. Trap number 2, the stated price. Do not blindly trust the sales invoice. You must always reallocate the total contract value based on standalone selling prices. Trap number 3, the SLA service level agreements are variable consideration. You must formally assess the probability of a penalty before you lock in your transaction price. SaaS revenue recognition is highly complex, but mastering it makes you an incredibly valuable asset to any modern tech company. If you found this breakdown helpful, please drop a like and subscribe. If you are a CPA candidate or a finance professional looking for personalized, one-on-one tutoring to master these standards, I am here to help. You can reach out to me directly at spadvisory.co@gmail.com. Thank you so much for watching, and I will see you in the next masterclass.